Hey everyone, and welcome to your deep dive into whether you should buy the 3 highest paying dividend stocks in the S&P 500.
We're going to be using this awesome article from The Motley Fool.
To break it all down.
Yeah. And,
Wow.
it's tempting to chase those big payouts when the entire market dips and yields get super low.
Right.
But sometimes a huge dividend is more like a warning sign than like a buy now signal.
Yeah, can be a little tricky.
You got to be careful.
For sure.
A high dividend yield can sometimes mean that the company's stock price has taken a tumble. And that's why the yield looks so juicy.
Yeah.
Let's just take the S&P 500 as a case in point, right?
Okay.
It's basically a collection of 500 of the biggest U.S. companies.
Most popular kids in school.
Yeah, exactly.
Right.
Popularity contest for stocks.
Uh-huh.
Over the last 2 years, it's gained almost 51%.
Wow.
But all of that success has actually driven the average dividend yield down
Really?
to just 1.2%.
Huh.
Yeah, and that's because when stock prices rise, yields naturally fall. So it's like a seesaw. Higher stock price, lower yield.
Yeah.
Lower stock price.
Higher yield.
Higher yield. Got it.
But within the S&P 500,
Okay.
some companies are offering much higher yields than that 1.2% average.
Okay, that's what we're digging into today.
Yep.
First up is Walgreens Boots Alliance.
Mm-hmm.
You might know them as just Walgreens.
Yep.
Their ticker symbol is WBA, and their dividend yield is a massive 9.1%.
Yeah.
Now, that might sound amazing, but here's the catch.
Yeah.
Walgreens had a really rough 2024.
Oh.
Their stock price plummeted by a whopping 64%.
Oh my gosh.
Yeah, to put that into perspective, imagine losing almost 2/3 of your investment in just 1 year.
Ouch, that's gotta hurt.
It's got to sting.
Yeah.
Yeah.
But how did that lead to such a high dividend yield? Did they suddenly decide to be like extra generous to investors?
Not quite. They actually had to cut their dividend, which means they're paying out less per share than they used to.
But because the stock price fell so dramatically, the yield, which is just the annual dividend amount divided by the current stock price, ended up going way up to that 9.1%.
So it's not as if they're like rolling in cash and showering investors with dividends.
Right.
What exactly caused this stock price freefall?
Well, for starters, their profits took a hit.
Okay.
Plus, they had to do what's called a write-down of $5.8 billion on their investment in Village MD.
Okay.
That basically means they admitted that they overpaid for this chain of primary care clinics, and they had to reduce the value of that investment on their books.
Oof, sounds like a pricey mistake. But the article does hint at some signs of a potential comeback, right?
Yes, there are a few glimmers of hope.
Okay.
Their pharmacy sales actually rebounded in the last quarter,
Okay.
showing a solid 12.7% growth compared to the same period last year.
Wow.
This was driven in part by higher prescription volumes and the impact of price increases.
Makes sense.
However, it's important to note that their retail sales, meaning the stuff you buy in the store besides prescriptions, actually declined.
So some mixed signals there.
Hmm.
What about their ability to keep paying that big 9.1% dividend? Can they afford it given all these challenges?
That's the million-dollar question.
Yes.
Right now, they're saying they expect to earn between $1.40 and $1.80 per share for the year.
Okay.
That's their adjusted earnings per share guidance.
Mm-hmm.
And their annual dividend is $1 per share.
Okay.
So if they hit those earnings targets, they should be able to maintain the dividend.
Right.
But if their earnings fall short, well, that dividend could be in jeopardy.
Okay. So investing in Walgreens right now is a bit of a gamble. High risk.
Right.
Potentially high reward.
Right.
You could snag a big dividend if they turn things around, but you could also lose money if they continue to struggle.
Exactly.
So it really comes down to your personal risk tolerance
Right.
and how confident you are in their ability to execute a turnaround.
Right.
Okay, on to our next high yield contender, Altria. Their ticker symbol is MO, and they're offering a dividend yield of 7.7%. Now, most people know Altria as the company behind Marlboro cigarettes.
Yeah.
And we all know smoking rates have been declining for years.
Right.
So how are they even managing to offer such a high dividend?
Well, it's interesting. Altria's stock actually performed quite well in 2024.
Really?
But not necessarily because their core cigarette business was booming.
Yeah.
It seems investors were looking for safer havens for their money amidst fears of interest rate cuts, and they flocked to high-yield stocks like Altria.
So it's a bit of a flight to safety play. Investors prioritize that juicy dividend yield over potential long-term growth.
Yep.
But can that strategy last?
That's the big question.
Right.
Right now, they're making enough money to cover the dividend.
Okay.
In the first 9 months of 2024, they earned $3.84 per share,
Okay.
which is more than enough to pay out their dividend.
Got it.
That said, their core business is undeniably shrinking, and that raises some concerns about the long-term sustainability of their dividend.
So they're stuck between a rock and a hard place.
Uh-huh.
Their main business is declining.
Right.
And they haven't quite figured out how to replace that revenue with new products.
Yeah.
But didn't they try to branch out into those new next-generation products?
They did.
Okay.
They made a big investment in Enjoy, a company that makes vaping products.
Okay.
But they're lagging behind their competitors in this space.
Oh, really?
Companies like Philip Morris International and British American Tobacco.
Interesting.
They seem to be struggling to gain a foothold in this growing market.
So here's the big question for you listening.
Mm-hmm.
Is a high dividend yield enough to compensate for a lack of growth potential? It's like getting a big slice of a shrinking pie.
Mm-hmm.
Eventually, there's not going to be much pie left.
That's a great analogy.
Yeah.
It highlights the importance of looking beyond the current dividend and considering the long-term trajectory of the company. A shrinking business, even one with a high dividend, might not be the best place to put your money.
Okay, let's move on to our final contender, Verizon.
Okay.
Ticker symbol VZ.
Uh-huh.
They're tempting investors with a 6.9% dividend yield, which is still pretty attractive,
Mm-hmm.
but I'm guessing there's a reason their yield is so high.
You're absolutely right.
Right. There's always a story.
While that yield might catch your eye,
Mm-hmm.
Verizon, just like our previous examples, has its own set of challenges.
Okay.
One of the biggest is that they've been losing market share to rivals like T-Mobile.
Why is that? Are they just not keeping up with the latest technology?
They've made some missteps, particularly in their 5G rollout.
Uh-huh.
They didn't invest enough in what's called mid-band spectrum, which is crucial for providing widespread 5G coverage.
Okay.
Think of it like this.
Yeah.
Mid-band spectrum is like the sweet spot for 5G.
Uh-huh.
It offers a good balance between speed and coverage.
Right.
Verizon didn't secure enough of this crucial resource, and now they're playing catch-up.
So they're trying to build a superhighway for 5G, but they're missing some key on-ramps and exits.
Exactly.
Got it. And how has that impacted their overall growth?
Well, growth has been pretty much stagnant.
Okay.
The smartphone market is pretty saturated these days.
Yeah.
It's tough to add new customers at a rapid pace when almost everyone already has a smartphone.
Right.
And their financial results reflect this.
Okay.
In the most recent quarter, their operating revenue was flat at $33 billion, and their adjusted earnings per share actually dipped slightly.
Okay, so not exactly a picture of robust growth,
Okay.
but they're still managing to pay that big dividend.
Right.
What's the catch? How are they making ends meet?
One thing to consider is their debt level.
Okay.
Verizon has racked up a significant amount of debt, which can be a red flag for investors.
Right.
High debt can limit a company's financial flexibility, making it harder to weather economic storms or invest in future growth.
Yeah, like having a huge mortgage payment hanging over your head.
Yeah.
It makes it harder to do other things with your money.
Exactly.
And to make matters even more interesting, they're in the process of buying another company, Frontier Communications, for $20 billion.
Wow.
That's a bold move when they're already carrying so much debt.
Exactly.
Yeah.
It's a lot to take on, and it adds another layer of complexity to their financial situation.
Right.
So the question for investors is Verizon's dividend sustainable in the long run? Could their debt burden and lackluster growth put that 6.9% yield at risk?
So what we've learned so far is that high dividend yields don't always tell the whole story.
Right.
You can't just look at that number in isolation.
Uh-huh.
You've got to dig deeper, understand the company's business, its challenges, and its future prospects. Sometimes that seemingly attractive high yield is actually a sign of underlying problems.
Exactly.
It's like seeing a flashy sales sign, but then discovering the product is damaged or outdated.
That's a great point.
Right.
It's important to remember that a sustainable dividend comes from a healthy, growing business.
Yeah.
It's not just about the payout ratio. It's about the long-term financial strength of the company.
All right, that wraps up our initial look at these 3 high-yield dividend stocks. We've seen that each company has its own unique set of opportunities and challenges.
Right.
Stay tuned for part 2, where we'll synthesize what we've learned and explore some key takeaways that you can apply to your own investment decisions. Welcome back to your deep dive. We just unpacked 3 companies with some of the highest dividend yields in the S&P 500. Walgreens, Altria, and Verizon.
Yeah. And it's clear that
Touch on your own.
strengths and weaknesses.
Yeah.
Each company is facing, unique challenges that could affect their ability to even maintain those tempting dividends.
It's been quite a journey so far, plummeting stock prices, dividend cuts, struggles for growth. It's a lot to take in. So let's pause here and just distill what we've learned.
Yeah.
What are the key takeaways you should remember?
Well, first and foremost, a high dividend yield isn't always a sign of a healthy, thriving company. Sometimes that sky-high yield is a warning sign,
Yeah.
a red flag waving in the wind.
It's like that old saying, if it seems too good to be true,
Yeah.
it probably is.
Exactly. Remember, the dividend yield goes up when the stock price goes down.
Right.
So that juicy yield could be a sign that the company is struggling and investors are selling off the stock.
So takeaway number 1 is don't be blinded by the yield.
Mm-hmm.
Look beyond that number and examine the underlying business.
Absolutely. Ask yourself, is this company profitable? Are they growing their earnings? Do they have a sustainable competitive advantage?
Right.
Something that sets them apart from the competition.
Right. Like what makes them special?
Yeah, these are the questions that will give you a better sense of the company's long-term prospects.
Because a high dividend is meaningless if the company can't afford to keep paying it.
Right. And that brings us to our second key takeaway. Pay close attention to the company's debt levels.
Okay.
High debt can be a real drag on a company's financial flexibility.
It's like trying to run a marathon with a backpack full of rocks.
Exactly. High debt makes it harder for companies to weather economic storms, invest in new opportunities, or even maintain their current dividend payments.
Got it.
So make sure you understand how much debt the company is carrying
Okay.
and how that debt might affect its future.
Makes sense. Our third takeaway is don't assume that past performance guarantees future results.
Yeah, just because a company has a long history of paying dividends
Right.
doesn't mean that streak will continue forever.
Right.
The business world is constantly changing, and companies need to adapt to survive.
So you're saying we need to look beyond the historical dividend payments and assess the company's current situation and its ability to adapt to future challenges.
Precisely. Now, besides dividend yield, what else should you consider when looking for income-generating investments?
That's a great question. What are some other factors that you think are important?
Well, one of the most crucial things to assess is the company's industry and its long-term growth potential. Is this an industry that's poised for growth, or is it shrinking? Does the company have a strong position within its industry?
You've got to think about whether you'd rather invest in a company riding a wave of growth
Yeah,
or one that's stuck in a shrinking market.
exactly. Next, take a close look at the company's management team.
Okay.
Are they experienced and capable? Do they have a good track record of making smart decisions and creating value for shareholders?
Yeah, the management team is like the captain of a ship. You want someone who's experienced, competent, and can steer the company in the right direction.
Another critical factor is the company's valuation.
Okay.
Is the stock price reasonable relative to its earnings, assets, and growth prospects?
Right.
You don't want to overpay even for a great company.
That's like buying a fancy car but paying way more than it's actually worth.
Right. And finally, never forget the importance of diversification.
Right.
Don't put all your eggs in one basket.
You don't want to bet your entire farm on a single company, no matter how promising it seems.
Exactly. Spread your investments across different industries, sectors, and asset classes.
Okay.
That way, if one of your investments doesn't perform well, the others can help cushion the blow.
It's like building a strong portfolio with a variety of building blocks. You need a solid foundation and different types of materials to make it withstand any economic storm.
By considering all these factors, you can make more informed investment decisions and build a portfolio that meets your financial goals.
Welcome back. We're wrapping up your deep dive into those tempting high-yield dividend stocks. We really dug into Walgreens, Altria, and Verizon.
Yeah.
Those good yields are definitely eye-catching. But as we learned, there's always more to the story.
Right. You can't just focus on the yield itself.
Right.
It's crucial to look under the hood, so to speak, and assess the company's overall financial health and its potential for future growth.
Right.
Remember, a sustainable dividend comes from a sustainable business.
Absolutely. We've seen how challenges like high debt levels, intense competition, and shrinking markets can put pressure on even the juiciest dividends.
Right.
And we've talked about how crucial it is to look beyond just the yield and consider factors like industry trends, the quality of the management team, and the company's overall valuation.
Right. It's all about finding that balance between risk and potential reward.
Yeah.
High-yield stocks can be tempting, but you have to make sure they fit into your overall investment strategy.
Right.
and your tolerance for risk.
Before we wrap up your deep dive, I'd love to leave you with one final question to ponder.
Okay.
It's something to think about as you continue exploring the world of income-generating investments.
I like this one.
Okay, so imagine you're on the hunt for investments that can provide a steady stream of income.
Mm-hmm.
What factors besides that dividend yield would you prioritize in your research? What would be at the top of your checklist?
That's such a great question because it really makes you think about what's important to you as an investor.
Right.
And there's no one-size-fits-all answer, right?
Yeah.
Everyone has different goals,
Huh.
different levels of risk they're comfortable with, different time frames for their investments.
Exactly. But by carefully considering those factors we've discussed, things like industry trends, the strength of the company's fundamentals, and the track record of the management team,
Yeah.
you can start to narrow down your options and find investments that align with your personal needs and goals.
It's all about becoming a more informed and empowered investor.
Right.
The more knowledge you have, the better decisions you can make.
Absolutely. So keep learning, keep asking questions, and keep digging deeper into this fascinating world of investing.
It is fascinating.
And that concludes your deep dive into high-yield dividend stocks. We hope you found this exploration helpful and maybe even a little bit exciting.
Yeah.
Remember, investing should be a journey of discovery, not a gamble.
Right?
Happy investing.